we have a lot of big activists and a lot of big companies, and we have a lot of big activists going after big companies, which isn't new. But what is new is we're seeing so many activists showing up at the same company. I look at Disney, I look at Salesforce, I look even at somewhere like Fidelity, where you have several rumored activists around it. What's driving that? Is this just activists running out of ideas, or is there something else here?
No, I think, the way I would think about this is, first of all, the level of activism activity is at an all-time record high. And then you've also got more activists out there than there were before. So we've seen a proliferation, if you will, of the strategy. And you put that together with a finite number of large cap targets, it's not surprising to us that you're going to have some overlap. I think what's a little bit different this time is we used to refer to this as a wolf pack, but wolf pack implies some kind of coordination amongst the activists. You've got an environment right now where you're seeing more of a swarm at large cap companies, and some of these activists are pushing companies in different directions. You can have conflicting demands that the activists are putting on companies. So this is going to pose, I think, this is going to continue to pose a challenging environment for most of these companies, and I think in particular for large cap companies where you can attack the company with multiple different lines of attack. And you also have a situation where activists, rightly or wrongly, view some of these large cap companies as being more defensive in a volatile economic environment.
And a lot of it has been centered around sort of technology companies, or at least companies that are significantly tech-enabled. Is there something to that? Is this something about the tech industry that makes it particularly vulnerable, or is this going to be something we see play out in other large cap companies?
So I think, it's a little bit of both. If you look at the tech sector itself, it has expanded its headcount more since COVID than really any other sector. And I think there's sort of a sense that if 2021, for instance, was a little bit of an aberration, what's the right amount of staffing that you should have, the right amount of headcount you should have coming out of more of a normalized 2019 onward? And so I think the tech sector is in particular focus because of that. There's also been a shift out of growth stocks into value stocks. And if some of these tech companies are going to grow a little bit slower than they used to, then you've got a re-examination or a re-evaluation of kind of the headcount profile. And so I think one of the reasons tech is being targeted is for those reasons, but our expectation is that this is going to spread, because this basic idea of back to profitability, back to margins, this applies not just to tech, it applies more broadly.
Is that what they're asking for, though? I mean, I feel like some of the more recent battles that we've seen, it's going beyond just the basic numbers, right? I mean, they are looking a lot more closely at operational matters in a way that I felt like they didn't do in the past.
No, it's a really good question. And I think that this might be something that, time will tell as to whether this is permanent or not, but many activism campaigns have had an M&A component to them. M&A has slowed down, and so it's less available in terms of getting a company sold or getting something divested. Private equity hasn't been as active as it was, a year or so ago. And so if you're an activist and those mechanisms are not available to you, then I think you want to search for other alternatives. The focus towards operations is more in line with where the broader investor mindset is, but it's also, I think, a reaction to the fact that the M&A outcomes are less available to them. Now, if M&A picks up, maybe we'll see a shift back.
But isn't there sort of, I mean, there has to be some degree of correlation between what's going on in the public markets and then what's going on in the private markets, because obviously private markets is what feeds into the IPOs, it feeds into a lot of M&A, and at least based on what we know right now about the private equity space, there's not a whole lot going on.
Yeah, by the way, there isn't, and the private equity space, though, has a record amount of capital that they've raised. Our expectation is that while there's a dislocation, eventually the leveraged finance markets will come back, and as they do, the private equity will come back. And private equity has been an enormous piece of the M&A market overall. It's now 35+% of overall M&A volumes. And so our expectation is that it's a matter of time before private equity returns. It's a matter of time before we have stabilization in the leveraged finance markets. When those things happen, I think the activists will react again and say, okay, well, these transactional outcomes can give you a big bump in the stock. They can happen relatively quickly. Maybe they refocus in that direction.
Avi, I want to bring you back to something you were talking about, this issue of swarming with the activists. You obviously have a big defense practice. I think Goldman, the sort of preeminent practice on the street. What is the conversation like inside the company, inside the boardroom, when you're facing not one, not two, but maybe 5 different activists attacking you?
Yeah, so look, I think it depends on the nature of the attack and the nature of the activists. Not all of these activists are equal. Some of them are activists that have a tremendous amount of experience and can move markets. Some activists are not able to do that. So when we're advising our clients, we're very focused on not just what the attack is, but who it's coming from, because I think the identity really determines whether you can carry the rest of the investor universe with you. Activists, when you think about the shareholdings that they have in companies, it's relatively minuscule, right? And so for them to be able to drive outcomes, they need the support often of the index funds. and very much the support of like the large active holders. And so our view, when you think about being swarmed by an activist, is who can really carry momentum, who can really carry influence with the broader investment community.
Okay, so if size doesn't necessarily protect you, sector doesn't necessarily protect you, performance, at least recent, doesn't necessarily protect you, is there such a thing as a safe company in corporate America from activists?
I think it's all relative. There's a sense of like you can be safer than others. And what I mean by that is that if you're an activist and you're making a run at a company, you've probably thought about other companies in that sector. You've probably thought about competitors. You've thought about other comps. And I think the way to think about defense and being in a good position is to make sure your absolute performance is in a good place, but equally importantly, your relative performance relative to your peer group is in a respectable place. And then I think if I take the analogy further, you want to make sure that you have given your investors a sense that you're taking proactive action, that you're not a company or a management team that needs to be pressured from the outside to take action. You have spun things off when necessary. You've divested businesses when necessary. You've returned more capital in a dynamic manner when it's necessary. And if you're doing all of those things and importantly don't have a governance profile that's out of step with what's required, I think you can be relatively safe against other options that an activist may want to pick out.
When you look at the governance profile of a lot of companies that came to market during the last big cycle, bull market cycle, and a lot of concerns here about the structure of some of those boards and the voting rights that were in many ways completely held onto by the co-founders. Is there any sense here that those companies, you have the ability at all for outside investors, outside activists to come in and shake up those companies, particularly when you talk about those co-founders having so much control over the actual voting rights?
Yeah, so look, I think it is a deterrent for an activist because, it's hard for them to sort of get a board seat if there's a voting control or a big voting bloc, sitting with certain founders. But at the same time, I think it's a deterrent, but not an inoculation. And I think if you're thinking about, a company that might be vulnerable, you want to ask yourself, first and foremost, what's my board profile look like? There are certain investors, namely the index funds, that look at the tenure profile of a board, and if it's over tenured, all of a sudden you could lose, their support. So that's one dimension to it. Another is what's the matrix of skills that the directors have versus how your business might have evolved. Post-COVID, certain businesses have moved in different directions. Has the profile of the board and the skill set of the directors kept pace with that movement? And so I think you look at tenure, you look at the skill set, and then you look at also, have you been dynamic about your board? Do you have, sort of refreshment that's taken place naturally over time? Or has refreshment only taken place when you've been pressured by somebody from the outside to do it? And so I think if you get those things correct, it makes you, again, relatively speaking, more protected.